It's finally earnings season, and we got a market moving crazy right now. Today, we're going to take you through all these bank earnings and all these early companies, and what does that mean for the rest of the economy, and which one of these industries are leading sector. We're going to take you through, even with these great earnings that banks have had, why is this financial sector still trading so low compared to the start of the year, while energy and all these other sectors like defensives are still so much higher. We got Robinhood making huge jumps over 10% after the release of a 25,000 pattern day trading rule getting completely gone. And why is this so important for Robinhood, and how does that mean more assets under management for them and how many more customers they may have in that base in the future? Then we're going to go into what in the world is going on with SoFi with this auditing, this muddy waters report that tanked their stock a few weeks ago. What's our forecast for them, and is this really going to have any long-term implications on the company? And with this, we're going to go into Robinhood and SoFi's business models, then finish up with our projections for each of those companies for you today. First thing I want to go through is what in the world's been happening with these banking earnings going on recently. So basically, the banks are the first ones usually to report during the earnings season, right? So you have your Bank of America coming in, your Morgan Stanley, your JP Morgan Chase, you have your Wells Fargo, your Citigroup, your BlackRock, and your Goldman, right? These are all so important because banks are where everything runs through. What is credit getting loaned out to? And they kind of see how are people investing and all this. So if banking earnings are good, that means people are making more money, they're loaning more money, and the economy is strong and going. Whenever credit tightens, right, rates go up or anything like that, that's when we get downturns in the economy. And to see Goldman coming out, BlackRock coming out, even though they're that private credit firm that we're all scared about, that's huge for the economy. While Wells Fargo's going down, but they have different stories. They're a lot weaker than the rest of these banks here. JP Morgan coming in great, Jamie Dimon leading them. Morgan Stanley coming in. Wow, look at those numbers right there. Look at those beats and everything that they've had. And we're looking at what in the world is Bank of America Corporation doing great beats coming in today. So just seeing all of that makes you feel a lot better about the economy, and that's some of the reason the economy's really been rallying. The stock market's been going up this week recently based on those Delta earnings last week saying they saw the consumer not getting worried about those gas prices, and banks now coming in saying that sector of the market is good. Because one thing is basically is that financial sector kind of outruns the market, right? So it's going to show cracks in it first before other stuff goes down, because like I said, all the lending and everything has to run through these companies. And we're going to say, should we be buying these financial companies right now? Because look at this. The XLF, the financial industry ETF, basically is trading down almost 7% still year to date. Oh, you have defensives up right now about 5% and energy up 20% this year. And if you know anything about what we've been saying is energy and these defensives are trading at way too high PE ratios, higher than tech, higher than all these companies. So you should be rotating out of those because the rotation into them already happened. And if anything happens, you're going to be stuck and you're going to be late on these. So I want to go to here the first article, right? Why is this so important for Robinhood? Why did their stock price go up 20 something percent over the last few days on this? Basically, Robinhood, if you know a lot about them, they're tied in a lot of Bitcoin because people want to speculate on Bitcoin. People want to do crypto, right? People want to do options in the market. And you have a lot of these younger investors who are more into all of that type of stuff. So whenever you go and you eliminate this day trading rule, you're going to allow people with this allows Robinhood, right? You got to think of this over time. How many more fees is this going to allow them to collect? Because basically what's going to happen is you're going to get people going and trading every single day, putting in 100 trades instead of being able to put in 3 trades every week, right? And on every little trade, Robinhood's going to be able to get maybe 0.01 cents on that trade because all these brokers take fees on everything. And if you know anything about fee revenue or recurring revenue, right? All these models like a SoFi, basically fee revenue is a lot more stronger and a lot less riskier because you're not like some of these huge corporations like a JP Morgan or one of those banks coming in and having to loan out all this money and worry about other companies down the line defaulting in private credit or private equity, completely going and hurting your books. So basically, this is so huge for Robinhood because this allows them to generate so much extra revenue. And even on top of this, they can get so many extra people on their site doing so much more with their money where they can make money off all of those transactions. So that's why the stock is bumping and going up way more because it's going to increase the amount of trading. And whenever you have all your younger investors, traders, crypto, all those people in an app, it's going to make more of them come in more revenue in the future. And then just to show that's why they also have so much growth in the future and growth with this trading. Look at what percentage of customers, right, 54% of their assets are basically millennials, 40% of the customers, and 29% of their customers are Gen Alpha and Gen Z, which you know what's going to happen over time. That number that Gen Z is going to make and Gen Alpha is going to go up over time, that money they're going to have invested because they're going to start working real jobs in the real world and not have debt from college or anything. And basically, you really don't see that many older people on this site. So Robinhood's going to go out here and have so much growth for the next future years as these generations go up, and that's just such something that you see between Robinhood and SoFi with all of these younger customers because they're building towards the future and they're going to become that giant, like the JP Morgan, that Goldman Sachs, that Bank of America, that people that the older, like the boomers or Generation X, the baby, all of them that are in today, these are going to be the banks of the future. And on top of this, they also have so much of their revenue coming in, right? They have prediction markets for them. They have, with them and Kalshi having almost a deal now, and they're able to go and basically have customer retention and organic asset growth. Because whenever you have customers coming in, they put some money in, they're going to keep putting money in that same bank account. Because why in the world would you have so many extra bank accounts going on? So that's basically the whole thing with Robinhood. And their revenue is also getting better because they're able to diversify more into prediction markets, and then they have all their lending. So that's just what allows them to be a multi-phased bank like SoFi instead of somewhere where you're at JP Morgan where it's either lending or having people invest in your company. You're one-dimensional, but adding these prediction markets gets so many extra other people on your site that are younger ages. Because what are all these younger age kids doing? I don't know how old you guys are, but maybe your daughters, sons, or if it's you. A lot of people like to go sports bet and all this, and some people are thinking of options as a new way of sports betting, or even these prediction markets like, hey, is Trump going to go do this in the world to China or something? Or is this bill going to go through? Who's going to win the election? Who's going to win the sports game? That brings in so many extra users on the site, and eventually that brings in so much extra assets under management, so much more revenue, so much more fees that they have, and on the bottom line, it hits them with net income. And then one thing they're doing this year is why they may have a little bit of problems. Not problems this year, it's just like a one-time thing. They're out here basically saying, hey, we're going to spend, we're going to try to market, we're going to try to get all this. The World Cup, we want to get people on our prediction markets and everything here. So then basically, if their market shares are also going up in the options market, their crypto, their margin, their equities. They even have deals out here like say, hey, you get 3% match if you go on margin in something. So basically that just adds more assets under management for them. And whenever you see that, like any company, like we've seen with Celsius taking more market in the energy drink and beverage, the more market share it does. If that industry keeps growing, then you grow even bigger with that industry. So you don't even have to keep growing as much. So that's what just basically going into there. Let's go into our Robinhood predictions to say, hey, this is what we think we can have going on for the next few years with this company, right? And just with our projections here, right, we got revenue growth at 26% next year. And their net income growth, like we said, they're going to be spending a bunch on operating expenses and SG&A trying to get all these more users onto their platform. Because like we've been saying, if you get all of these younger users right now, think of how much more assets under management that's down the line and what can that do to build that brand and that company. So basically they're going out here, they're spending for the short term saying, hey, in the long term, we're going to have this big corporation like this JP Morgan or something is exactly the business plan they're trying to do. And that's what you want to see in these companies that are forward looking and are willing to say, hey, right now, they might go down. That's what we're seeing with a lot of the Mag 7. Now, here's nice where they're not spending $200 billion of CapEx, completely destroying their margins, their free cash flow. But here it is nice to see that. So we got them growing at pretty moderately, 26% rev, 2017, and net income from 22, 25, 2020, picking up a little bit and helping expand those margins close to that 45% mark of that net income margin. Then with that, a PE ratio of 30 to 40, 35 to it's pretty fair for a company to be growing like this top line and bottom line. 17 to 20 is growing pretty good. They're fintech, so it's like annually recurring revenue, right? You know these people aren't going to be taking their money out. They're going to be putting more in. So that's why they're like trading at more of compared to the financial sector, which almost is like a one peg ratio, because they have so many distinct portions that are growing in their company, not just people putting money into bank accounts and investing. They have crypto, and more people can be trading and doing this, so they're going to be getting a lot more fees than all these other banks. With that, you're going to get about a 15% CAGR mid for the next few years. At least you're doing a little bit better than the market. Our bear case right here, we have them going 20, 15, 10, 10, and just kind of falling off in that net income, that revenue. Say maybe this prediction marks doesn't work out, call sheet, something falls through, and they take a huge portion of that. The Gen Z people get stopped going into trading. Bitcoin doesn't do that good, so people aren't investing as much money that are really trying to get those huge gains in them. That's what you would be seeing here with those margins not getting there and the revenue not growing too much. So basically, we would have them doing almost about, I guess, even to down over these next few years. And I mean, honestly, even if you were technically growing at this here, right here, you could honestly just be growing that. You could honestly go down to like 13. So it could get even worse for them where they could be down. But to be fair, I think it is hard to see them down over the next few years, even from this $86 share price. Obviously, at $70 would have been great. Like, imagine we had it. They were at what, $70? Imagine we had them at $70 for this. Like, let's just say 74 is close. Like 34, 70. I mean, you're looking at a 22 compared to what it is right now. So even your bear case would have been some positive numbers, but there's just always stuff that happens with these. That's why you want to buy your stocks and not wait for it to get even lower and lower, because sometimes you just miss the move. And then our bull case for them is, say, prediction markets pop off. The Gen Z gets more money faster and faster than they think. That keeps putting it in. And they're able to pull some of these older, like 50-year-old type of people into the company and invest with them with the new card they have, or just anything on their site that has better features. Maybe you get more of a return on your money for just keeping it in there. That's what it'd be allowed on, but they're going to grow revenue at 25, 30, 25, 25, just a little bit better than their base case, and trade at higher P ratios, just a little bit higher. And at that point, then you're getting that CAGR close to 30% for your bull case there. So right now, if you're going to ask me, hey, are you going to go out and buy Robinhood today? For me personally, no, not because of I don't like the returns, but I just feel like there's so many better returns in the market. If you would have asked me them whenever they're 70, I would have said I would be so much more likely to buy them, but I still just see better returns. Now you could diversify and have some money into them, but we're gonna go to my next stock next, and we're gonna hear my thoughts on that, and then you're gonna hear like, am I in this SoFi or am I in HOOD? So I mean, those are our numbers right now we have, and that's what's happening. They're pretty attractive. If you're really bullish on them and think they can hit those numbers, hell, they'll be great. They're gonna outperform the market by 2.5 times. So that's all you can want. But let's get it right into SoFi and Anthony Noto's company that we've been talking to you about running our projections. Basically, this is their business model. They have this financial services productivity loop. So say you're someone who has a loan at 20 to 25%, a student loan or something that you're paying from college, so it's younger kids, or even a loan on a house, car, anything, right? Basically, SoFi says, hey, you can get a loan from us to pay off that loan for only 10%, 7%, so you get a lower rate. So basically, if it's a $100,000 loan, instead of paying extra, you can save like $8,000 to $20,000 on that loan. You can keep paying it back faster and all this stuff, right? So then once you're in SoFi, you have this account for a loan, you go on their app. You're able to go on, you can do your personal loans, you can do SoFi Money, you can invest, you can have a credit card, you can do crypto on there, you can have your bank account, you do all this type of loans and financial services on it, that whenever you would go on like a JP Morgan, like you're not going to have your bank account tied to your inside your investing account, where you can also go do crypto on there, where you can also get loans on it. So basically, it's the products, once you're in one product and you get in that ecosystem, they keep building off of each other because they're so easy to use and there's so many products that they have. So that's their call, was they're getting a lot of these younger kids coming out of college paying off these loans. And then, like I said, these younger kids are going to get more and more money, and they're going to grow into a huge JP Morgan-esque type of bank, even faster than Robinhood does, in my opinion. Because like whenever you're using a bank, you like your APY you're getting, they have really competitive because they're fintechs, you're getting 4% on there. Why would you switch off of this whenever you can do everything so easily and so methodically? So basically, they have this competitive advantage that no one else has with all these services and products on one singular platform. And basically, if you look at their member CAGR growth, actually it was going down a little bit good, and then 2024 is a little down, and then this year it re-accelerated up to 35%. And this is nice to see also, this products CAGR jumped up to 37%. So basically, the way that they're measuring all of the products, everything they have on there is, hey, you go on there, use a loan, that's one product, and then you make a bank account or something, that's 2 products. So just seeing the bank account and these products growth with the CAGR shows that people are on the site and they're using newer and more products. So they're expanding from, hey, maybe I just made a bank account, now I'm going to get a loan on SoFi. So basically, they're getting so much more fees, so much more revenue, and you're stuck in the site, you're stuck in that ecosystem almost. Because If you do everything on one site, why would you go and use like someone else to go and do your checking accounts while you use someone else to do your investing? Why not just do it all on one app? Isn't that so much easier, so much more time efficient? And that's what their whole business model is, and it's genius. It's almost like a SaaS type of company where you're so intertwined within the whole company that you can't leave. Here, you're intertwined between all of your accounts. I'm sure it takes time to set up. So it's just a pain for you to go and leave this company. And then what I wanted to show also on here is, right, another reason why we love them is they're this asset light type of bank. So they're not like the JP Morgan, Bank of America I was talking about in the other video, private credit. Go watch it if you haven't, because that's something you really should watch about this economy right now. Basically, they're not really as much exposed to that because a lot of their revenue they do, right, is their fee-based. So they'll go and say, hey, I'm going to loan you $1,000 and you're going to pay me, I don't know, 5-10% interest on that, right? So instead of just holding that loan on their books and risking it defaulting, they're going to go and they're going to sell it off to some third-party company, right? Something, could be private credit or it could be one of these other type of companies, right? So then they're going to say, hey, okay, the other company's like, okay, so you maybe make $1,100 on this loan. We'll buy it for you from $50. So say they make $50 still, and they don't carry that risk of that loan, keeping it on their books. That's why they're so nice, and that's why they're better to survive downturns in the market and safer than all these other banking stocks, because this fee-based revenue is growing, is becoming a bigger portion of their business model, to where if you don't have to worry about people defaulting, because that's always the biggest risk about these banking stocks. If people can't pay back their loans, they keep them on their books, and it hurts them on the bottom line. So that's just basically about SoFi. What in the world has been happening with Muddy Waters? Basically, Muddy Waters comes in and says, hey, they have all this debt on there. Their personal loan, saying they're charging completely different rates, and they're not reporting it. They have no idea what they're doing, even though they're a banking company. And they're lying to the public, diluting shareholders with all this stuff. That's complete BS, right? Let me tell you why Muddy Waters did this and why they possibly could take legal action. Basically, what happens is Muddy Waters was probably short SoFi, right? And they're looking at the business model and they're saying, hey, wait, this business model is great. These numbers are great for the company. We're short. We're going to be screwed and we're going to lose money. So SoFi, they're worried about them. So they come out and say, this is what a lot of times they do. A lot of times these big companies, whenever they want to get out of these short positions, they're going to go publish and say, hey, we're short this company. Say some BS. They can make up some stuff because this company really want to get in a huge legal battle. Probably not. And they use that as their exit liquidity to short. And what do? They flip their position and they go long in it. So they probably got out at $15, and now they're sitting here while it's $18 saying, hey, we just made 20% on this company after we made some money shorting it on the way down. That's how this type of stuff works. Because what do we always tell you? You can't go with the group trade because everyone saw this and decided to sell off the stock, right? That gives you a great place to buy because people have so many other agendas and whatever in this market. They want to lie to you. They want to deceive you because what does that do? It gives them better entry prices and exits without having to show it. So that's what happens. And then right after that happens, Anthony Noto came in and Bert purchased millions of dollars of shares a few different times. The first day he was able to buy it, and then he bought some after the Muddy Waters. And whenever you have a CEO doing that, whenever you have a CEO or an insider buying, there's only one reason, right? That means that they're super, super confident in the business. Selling could be so many reasons. They could have tax purposes, divorce, something else, right? You never know why selling. But if they're buying, there's one reason. They believe it's undervalued and has so much value for the future. And one thing about Noto, right? He was a former Goldman Sachs banker. I'm pretty sure he knows exactly how to do investing. He's learned from Wall Street. And he left Wall Street because all of the best executives and CEOs leave Wall Street. And just one more thing. Who in the world is their auditor? Deloitte. Do you think Deloitte's letting them go and faking this prestige accounting firm? Absolutely no. This report is complete crap. And our other favorite thing we like about SoFi so much is look at these EPS estimates and revenue. You see they beat every quarter. Like we've said, they beat for 2 years straight. Look at how huge they're beating on EPS because this is a company you want. This is a company you say, hey, we're going to get 0.60 EPS. They're going to hit 0.60 EPS. They're going to do way better than that, actually. But you can put your base case pretty close to that and be confident in the company for the future. So that's the companies you want to say, like, hey, are we confident in management? Do they actually hit numbers? Are we going to be confident in our projections? So that's exactly what you want to be looking for in all of these companies because it's like, hey, can I sleep good at night knowing this company's going to come out and beat earnings, right? And especially a bank, you really need to see that because there's dangers in this. So basically all Noto has to do is just limit the credit, limit the exposure, and they're going to keep growing because there's people like you, me, young people, old people, everyone in this company that our money is going to go up and grow in the future. We're going to have more for them to make money off of with their fees. Let's go into SoFi, right? Let's just take you through a projection. I know I showed them in the video yesterday, but I just want to re-show them back just because of how confident we are. And the reason we didn't really want to investigate in HOOD is we're already exposed to the finance in that sector, which you could get another, but we just love this one so much more than Robinhood, even at the $70 price, right? So they're supposed to grow revenue at 30% over the next few years. So we only have them at 31. And if you look back, they beat by more than that on average pretty much every time. So that's a great sign to see. And then let me just go. I can go show you what their rule of 40 for SaaS is good. Let me go see if they have it on here somewhere. Just so you guys can see, where's here's their guidance, right? 30% year-over-year growth, and their diluted EPS is going to go to 0.60 this year. So look at that, 54% year-over-year growth, right? So what's going to go on is 31, 31, 31. Net income growth is 72, 42, 42, 42. And they're going to be getting diluted a little bit. We're just putting that in their base case. Maybe they don't. Maybe they're done but they just did dilute at $29 a share, and look what the share price is now. So that should just give you even more confidence. With that, a 50-60 P ratio is fine. They're still trading under a peg of 1, less than the industry average. Imagine them right here. Like, let's just go here. Imagine if they go here to 60-70 P ratio. We're not let's just put this in to show you, right? 60 to 70 because they think they can keep growing at this, right? 66. They're going to $116 stock at our base case. And that's not even an insane valuation for a PEG ratio. That's just the stuff you got to see and think about for these stocks. Like, hey, they're going to do better than what analysts think. And that 2% beat, all this stuff, isn't anything crazy for a company like this coming down the line in these years. Their bear case, obviously, they could get killed. There's some danger in them because, hey, they're banking, they're exposed to credit way more than Robinhood is. And they could just have people fall off. And we like to show you our worst possible case scenarios. Where realistically, after you've seen how many times they've been beating, are they really going to hit this? That's why it's only 5%. But we just want to put in just bear cases, say, hey, if this goes really bad, this could go really, really bad, just to show you and make sure you understand what's going on. And they could go honestly close to zero and be terrible stock-wise, right? But overall, it's probably not going to happen. And we like to be so, like this is, if they really would do a bear case, it would probably go like something like this, 2020, 15. But we just want to make sure we're keeping you know what I mean? We're trying to keep and make sure that we're like showing you guys, hey, what could be the worst possible thing ever to happen to a company like this, right? Just because you got to make sure you're doing that. And I mean, if they're trading at 15, you go 15 to 20 is probably fine, right? So you could probably go and say, hey, like, they're going to be trading at that. That's like a high piece. So, I mean, you got to go like a 13 to like an 18. For a company growing like this, that's would be like even reasonable just to say like, hey, they do a little bit better than what we think, right? Just throw that in here and make sure that stuff is like that. So, I mean, that's what basically it would go. They could be trading. And like we said, they're already so beat down to the point where it's like how much lower are you really going to get a company like this going down? So, I mean, even with these numbers here, right? So you put these in, you're still getting like a 9% CAGR. You're just getting hit hard by a company like this. So there's always risk in that banking sector with every company. And then our revenue growth, our bull case, isn't even anything too crazy. They're basically just growing 35% of the top line and then 47%. So 7% really, 47% to 40% like they're saying, and 5% extra on top of 5% on top of that 30%. So with this, you're getting a price of $144 a share and about a 70% CAGR. Now it's a little bit higher because like the stocks ran since we even like keep giving you, because this stock is hot. This stock's like, you got to go now. Because I mean, you're getting a beat. Some, like we said, you can't just wait all the time for stocks to come down. But thank you so much for watching this video today. If you like the software, go check it out. We have our beta out and everything on this site. So go look at that and see like, is this good for you guys? This is going to help your projections. There's bars, and it's completely free for everyone to use. But just like and subscribe if you want to see more videos also.